Investors who did the opposite of what Citi analysts recommended last year would have more money in their pockets than those who followed their tips. A new study into share recommendations made by experts illustrates why they should always be taken with a pinch of salt, and you should always do your own research to back up any tip. The 10 FTSE 100 stocks that attracted the highest percentage of an analyst buy ratings dipped by 9.3% in the 12 months to 31 December 2017, according to the research conducted by the investment platform AJ Bell. Meanwhile, those with the largest proportion of sell ratings flew in the face of the doom-mongers and grew by 9.5% on average. Shire was the most popular investment, with 25 out of 30 analysts rating the stock as a buy. However, the hype did not translate to stellar returns. In fact, the stock fell by 16.7% over the period. In other words, a £1,000 investment would have fallen to £833. The FTSE All-Share index had a total return of 13.1% including dividends over the same period, and data shows that had you invested £1,000 in the legal and general UK index trust, a simple index tracker, you would have ended the year with £1,131. Another popular stock that failed to live up to its billing was Dixons Carphone. It received 12 buy versus 1 hold and 1 sell rating. Ignoring the majority view and following the solitary sell recommendation turned out to be the right call as the stock plunged by 43.9%. The dip in performance resulted in the demotion of the electrical and mobile phones retailer from the top tier to the FTSE 250 in March last year. The worst performer on the list was Provident Financial, which gave star manager Neil Woodford some headaches over the past year. The share, which was rated a buy by 8 out of 10 analysts, returned minus 68.6%. There were also some sell recommendations that ultimately turned out to be the wrong shout. Rolls-Royce is one of these.No. Fewer than 12 out of 19 analysts rated the engineering company as a sell at the beginning of 2017, but it rose by 28.5%. Meanwhile, Royal Bank of Scotland, another stock that the majority of analysts did not rate, rose by 23.8%. However, there were some good calls. The buy rating for travel and tourism group TUI and packaging company Smurfit Kappa was justified as the stocks returned a healthy 32.4% and 33.1% respectively. Under the new regulations, or Mifid II for short, brokers are required to unbundle investment research costs from the overall broking commissions. It is predicted to lead to fall in the number of analysts. Mifid II has shown a bright light on who is paying for analyst research, but of equal importance is whether that research is actually adding any value, Russ Mould, investment director at AJ Bell, said. The cost of this research will ultimately be borne by customers, whether that is directly or indirectly, and a look back at 2017 suggests these ratings needs to be treated with kid gloves, especially when it comes to the FTSE 100. Ultimately, what the data does seem to show is the well-informed, diligent, expert broking community has little more idea of what is coming than anyone else, at least in the short term. Anyone prepared to pick their own stocks, rather than pay a fund manager or index tracker fund to do it for them, must therefore thoroughly research any company for themselves before they even think about buying its shares. What to take from this study? While Citi analysts are well versed in matters that can affect the price of a stock, they're not immune from making the wrong calls. Analysts often come up with detailed explanations, complete with comprehensive analysis of a stock's financial health and the outlook for the wider sector, to justify their recommendations, which often sounds all well and good. However, put bluntly, sometimes their research is just plain wrong, or doesn't factor in, or fails to appreciate the impact of a pending variable like, say, the outcome of an election.